Hi, good afternoon, everybody. So we are back with yet another edition of Netra, the February edition. And like always, we cover various data points for India and for the global scenario. Just to give you a little context, as for India, Sahil will talk in length about the current phase of low volatility in the Indian markets, the rather moderate foreign flows, and the small cap and mid cap valuations, and a number of other data points. As for the global context, our focus for this edition remains largely on the US developments. And so I'll just leave to that. Sahil will take you through the rest of the presentation. And during the course of the presentation, please feel free to drop in your questions in the question answer tab below on your screens. We'll take collectively all the questions towards the end of the presentation. Thank you. Over to you, Sahil.
Thank you. Thank you, Pragati, and welcome to all of you. Thank you for joining in on the webinar. And as always, we will discuss the Feb edition of Netra. We write this publication on 5th of every month. This time, what we are discussing is a number of things on volatility. And this, I think, is an important topic because markets threw up readings which are slightly rare, not entirely rare, but some of the readings that we've seen after a very long period of time. And there are first three slides focused on that. So let's get started with the first number. And so there is this very important, change which has occurred in the market. So if you look at this slide on your screen, these, gray areas that you see, which is going down from the zero line, this is percentage change in Sensex, which is called a drawdown. So for example, if Sensex hits a lifetime high, how much does it fall, from that level, and then it goes back up and creates a new lifetime high. So whenever it falls, let's say 10%, so this gray line will fall to this level and then it recovers back. It will go to zero and make a new lifetime high. The moment it remains at lifetime high, you see these black phases where it continuously remains at lifetime high, right? So these are the drawdown phases of the Sensex from lifetime high. And this is data going back from 1979, from where the Sensex data is available. Sensex, of course, was launched in 1986. The backtested data is this phase which is available, which the index provider, provided with in that manner. So technically, if you look at the index itself, from the birth of the index, the data will start from here, where you could say that volatility forever, except the last 8 years, has been much higher, which means that, I have defined here by what do I mean by volatility, what do I mean by a bear market. I have put a definition here. It's very difficult to put definitions, right? And this is only one attempt of defining what a bear market is. There are many other ways of defining a bear market. I have defined it as, decline of 20% or more from the lifetime high, and the index taking more than 1 year to recover back to a lifetime high. So just to simplify what I'm saying, so for example, imagine that Sensex was or Nifty was at lifetime high before COVID. In January 2020, it was at lifetime high. Then it fell during COVID more than 20%. Let's assume that it took more than 12 months. For example, even after, let's say, March 21, it did not rise back to 12,000. So Nifty fell from 12,000 to 7,500. Let's assume that even in March 21, it was below 12,000, let's say maybe 11,000 or whatever number, which means that it took more time to revert back to its lifetime high, which means that the drawdown was deep and long. That is how I have defined a bear market, which means that the market falling and taking at least a year or more to recover. And by this measure, except this COVID phase where the market again recovered within 9 months, right? Which also does not qualify as, as a bear market in terms of time. Market has not given us a drawdown long enough in the last 8 years. And this, you could say that this is the second instance. As I said, first instance is a back calculated data. If you compare it from actual index numbers, this is the first instance of that happening, right? Now, there is, of course, a viewpoint that we had such a large number of events in the last 8 years, right? We had COVID, we had GST implementation, demonetization happened, many other events happened, elections happened, global, domestic, all of these developments took place. And uh, just like any other 10 or 8 year period, there were many events. There are, of course, there are always events happening in the world, and they will continue to happen in the world, but they did not result in price volatility. And that, I think, is the most important takeaway, that market participants have seen only shallow drawdowns, which means that they have not seen a very deep drawdown for a long period of time. Now, why this is important? So I will tell you very important, takeaway. If you go back to, let's say, last 100, 200 years of history, and if you compare periods where interest rates were very, very low, just like what has happened in last 10, 15 years, except the last 9 to 10 months, globally, interest rates have been very, very low. When interest rates are low, there is a search for yields, which means that people don't buy bonds or fixed deposit. They go towards equity and other risk assets. What they do is that they buy these risk assets, uh, and they hold on to them. Even when they do not perform, they rarely sell those assets because bonds are yielding nothing, right? So they don't have any incentive to move anywhere else. And over the last 10, 15 years, uh, in some countries, like in Japan and Eurozone and some other countries, interest rates were actually negative. So you were being punished to hold any other assets than equity assets. So either you were buying equities or you were not selling them. And that is what has produced this low volatility. Even in India, I think the monetary conditions slightly improved post 2019. Post COVID, they have improved dramatically because of the way central bank has, acted and changed its policy stance, and that has got reflected in the market also. What is the conclusion? The conclusion is that volatility has been quite low, and we've seen that volatility comes in clusters. That means if it rises rapidly and then remains elevated. That means market remains very, very fluctuating, very volatile. If the volatility reduces, then the markets remain very, very, uh, they fluctuate very less. That means the volatility is lower, right? Which is what has happened over the last 8 years. Can it increase in 24, 25, 26? We don't have a crystal ball. We don't have the forecasting ability. But history says that with lot of events coming up, which I will show you in the third slide, there is a good possibility that volatility could rise. When? Possibly in this year, right? And which we'll go to the second slide. What we've done is we've taken three slices of market capitalization: large cap, mid cap, and small cap. And very interestingly, there are readings in small cap and mid cap which are very, very important, right? So if you look at the small cap index, data again is taken from BSC. These are BSC indices. And if you look closely, 2023 was an year when there were very few down days. The second lowest number of negative days. What is a down day? When the index closes negative. For example, like Nifty closed negative today, it will be counted as one, right? So this is second lowest number of negative closes in a calendar year after 2003. And now, interestingly, in 2003, the index was not there. It was, it started in 2006 and back calculated, which is what the index provider has given us. So effectively, in real life, this is the first instance of lowest negative number of negative closes in any calendar year for small cap. And similarly, the second lowest number that we saw in mid caps, right? Prior to that, we had reading which were 2017 for mid caps and also 2017 for small caps. Interestingly, large cap are also very close to the top numbers. You can see the least was again 2003, 97 readings, 2006, 97 readings, and for 2023 it is 101. Although this is not the top five results, it is the number seventh result, right? So which means that small and mid cap have depicted a pattern which is very, very rare. What is the takeaway from this pattern? So what we did is we looked at the data going back in history, and on an average in any calendar year, large cap face a drawdown of 19%. What does a drawdown mean? That means imagine that today Sensex, let's assume, is 70,000. It started at 70,000 on 1st January, right? Let's say it went back and rose to 80,000 during the year. Whenever, right? Maybe starting January, By the time we reach Feb, it is at 80,000. From 80,000, let's assume that it corrects 20%, right? So from 80,000, it falls 16,000 points, goes to 64,000, which is a 20% correction. That is a drawdown. And then from 64, again, it starts to rise back, right? So from the highest point of the year to the lowest point of the year. But you can't calculate this by just by doing high to low, because there are many years where low is formed first and the high is formed later, right? So it takes you have to take the high of the year and then the decline from that level, right? That will give you the proper definition of a drawdown. And historically, what we've seen is that large cap drawdowns, we have mentioned it here, are about 19% in any calendar year. Mid caps are more, 23. Small caps are 26, right? These are the average number historically, right? This is the drawdown which happens in any calendar year. But interestingly, the data that I put for all the three market capitalization, that is on top this table, the three tables that you are seeing here. What does this table tell you? There is a column called max drawdown in the next year, which means that any year where the down days were lower or volatility was very low, the next year the drawdowns were this. Okay, this is the number that I put here. And as you can see, the drawdowns on an average following a low wall, or I've highlighted it as an unsettling calm year, are much higher. How higher? For large cap, instead of 19%, it is 27%. For mid cap, instead of 23%, it is 32%. And for large cap, or for small cap, instead of 26%, they are 37%. So on an average, years which are followed, preceded by very low volatility are followed by years with persistently high drawdowns. And therefore, there is a possibility that in this year or possibly next year, most likely in 24, the index shows that there is a probability that there could be a much higher drawdown. And why is it important now? Because since Jan to now, we've already seen a rally, in all small and mid cap and large caps. We've seen indices come up between 5 to 15%, depending on which index you are looking at, from large cap to micro cap. There has been a large rally. So when the drawdown happens, it will be from those highs. I don't know what those highs are or when they will be made, but these drawdowns could be much more steeper. And these are the historical averages, right? It can be less than the average, more than the average, but history shows it is much higher than a normal year, where the drawdowns are 19, 23, and 26. These years are followed by much steeper drawdowns, and that is the probability which is happening this year. Third is, let's look at volatility globally, right? Globally, all indices, we've taken three. There are about 9 to 10 global VIX available, which are useful to look at. We've put three here: India VIX, US VIX, and Europe VIX. Europe VIX is an amalgamation of a number of markets. And as you can see, all of them are close to their multi-year lows, right? Maybe not at exact lows. Volatility in 17 was even lower, but more or less, at 95, 97 percentile of their overall data set. So volatility is very, very low. In itself, it does not make any sense, right? It doesn't matter if volatility is low; it can continue to remain low for a very long period of time. But what we've seen is that upcoming elections, events, high interest rates, high valuation, overheated markets, when you add these data points with low vol, it creates a higher probability of a drawdown. And also recently we came across a very interesting product which has been launched in global markets, and I have written it here. What it does is there is 0 day to expiry options which have become very, very famous globally, which means that traders are trading options which will expire on the same day. Okay, which is called ODT or 0 DT, 0 day to expiration. The overall value of these options has crossed $1 trillion as of today, and maybe even higher. These are slightly dated numbers. Interestingly, a product has been introduced which sells at the money options and 5% in the money options. Okay, which means that, and it has about 270 to $80 million of AUM just in 3 months, delivering 11.5% returns, right? And it is a derivative income based product. So delivering massive outperformance just by selling option. And why, when these products come up, why do they come up at these points in time? Because volatility is so low that participants have sort of become immune, right? They believe that this volatility will continue to remain low, and this kind of free, option selling premium will be available throughout. And this is exactly opposite of what a number of risk managers have been advocating and running strategies. And we've seen some black swan strategy which buy deep out of the money put options. And if, let's say, an event like COVID occurs or global financial crisis occurs, they provide great protection, downside protection, right? These are exactly the opposite strategies. These strategies are designed to get killed if there is a very large event. And they then, in themselves can create market dislocations. So imagine a very large AUM riding on these strategy, and these AUMs are very, very large. You can, if you research it, you will find that a very large number of strategies are running by selling at the money or in the money options, put options across the world. And why they can become very risky if the index falls by 4 or 5% intraday for whatever reason, right? It could be anything. These strategies can skew it massively, right? Because they are designed to take advantage when the index does not fall. And these strategies skew market returns immeasurably, because of other events. Although they don't have anything to create those events, but if any untoward event happens, they will have to come and sell in the market. This is again a very, very unsettling development which we have seen. And usually we've seen these kind of products become mainstream when vol is very, very low. And if you look at the first three slides put together, you will know that these kind of low walls, when they occur at valuations which are high, markets which have already run up significantly, and they are also overheated, they become slightly more, alarming, or you have to take notice. Now let's look at how high the valuations actually are, in specifically in case of Indian small and mid caps. So we looked at data from history. We went back to 2010, and if you see in 2010, India's small cap companies were trading at a discount to Chinese small cap companies, and to US small cap companies. So against both these small cap indices, we were trading at a discount, right? And if you fast forward to today, we are trading at a premium, a very high premium to China and to US. So, which means that we have come full circle from trading at a discount to trade at a premium, and this premium is also close to lifetime high, right? We have eliminated COVID data, which was distorting, the numbers because of the low base in all the three countries. The PEs were, out of whack, so we took a smoothened parameter. So we are already close to lifetime high premium, and you can see the COVID numbers here, right, on the right hand side, which is India's small and mid cap valuation versus the world small and mid cap valuation. We are currently at very, very high premium. If you remove the COVID high, which is a distortion, we are close to at record high premiums, right? Second is, if you look at the liquidity condition in Indian market, it has slightly deteriorated. Interbank liquidity has come down. It is now in a deficit, while valuations for small and mid caps have gone up, which is generally does not happen, right? When liquidity conditions begin to tighten, for example, in today's RBI's policy statement, governor made it very clear that they are not in a hurry to cut rates. They are going to wait and watch, see how inflation evolves, see how global risk evolves, and then probably take a call, which means that monetary conditions could remain where they are right now, aided by what RBI's wait and watch approach, which means that the uh, valuation comfort for mid and small cap is completely absent. And I also drew a price to book chart, which is not there in the full deck for Netra, but I just put it additionally here. And you can see this is price to book ratio for Nifty micro cap, which is stocks beyond the first 500 stocks. So 501 to 750 in terms of market capitalization. This is that index, micro cap index. The blue line is price to book of that index from Feb '08 or Jan '08. And the other is Nifty mid and small cap, which is stock number the 100 to 250 plus the next 250 stocks. So 100 mid caps, 150 mid cap stocks plus 250 small cap stocks, which makes it 400 mid and small cap stocks. As you can see, the price to book is above the 2017 high, which was in itself a massive rally. People who are part of the market since then will remember how in 2018, mid and small cap suffered corrections. And similarly, we had 2010, where again for an extended period of time, mid and small caps did not perform. And 2008 was, of course, a global phenomena where most capitalization suffered corrections. We are close to those record highs, right, in terms of valuations for mid and small cap, which again gives you less comfort, to participate in this category, given all the volatility indications which I told you earlier, right? So this is the first section, which I think is very, very important. And as I described earlier, focuses on how vol has been much lower than the past, and it makes participants a lot more complacent. And our message is don't be complacent in these categories. Look at the risk. Most likely remain staggered or possibly allocate incremental money to multi-asset strategies or to fixed income strategies, which I will not now talk about. So one area where I think we've seen a large decline recently after HDFC results is banking. And as you can see, for banks, this is Bank Nifty. The price to book ratio has again come back below 2. And history has shown that whenever banks are cheap, usually they do a good job in the future. Last 1 year, they have not performed. Even post COVID, their performance has been weak, largely driven by very large weights of two large banks, which have not performed. Other banks did well, but on the whole, the index could not perform as much as Nifty did or broader market did, and therefore the underperformance is quite visible. But again, they have become much more cheaper, and I think they are one of the better plays in terms of how valuations are placed, and they give a much larger margin of safety. And we have spoken about this earlier also. We have highlighted this earlier also that this is the part of the market where margin of safety is completely opposite of what is working in the market today, right? Small and mid caps and micro caps, which are doing extremely well, margin of safety is very, very low. This section, which is not doing well and has also declined recently, the margin of safety has improved rather than being stagnant. It has actually gone up. So the ability of investors to participate in this theme should go up, and we believe that this is again one of the better themes to look at. Second place to look at is, as I said, fixed income, and I will talk about that on why am I mentioning that. But this chart is about cumulative foreign investments coming into India. And what we have done is we've added FDI that we receive. We have also added FPI equity flow, the FI flow on equity that you watch every day. ECB's external commercial borrowing, which is sort of a loan, and FPI investment into debt. These are the inflows that we get in terms of dollars across the year. And as you can see that there is a common narrative that foreign investments in India are rising at a very fast clip. But one view at this chart will tell you that they are stable, but they haven't been rising at a very fast clip, right? And we've written here that India has offered very high returns, very high earnings growth, stable currency, stable inflation, good policy environment, but still we have not got very high inflows. Maybe we'll get it in the future, and that is the expectation or hope. But till now, we haven't got very high flows. Post COVID, we saw a huge surge of during COVID, FPI equity flows and FDI flows. FDI followed through in the next year, although FPI equities left. And then again in the next year, FPI, there were outflows. We have put this chart in December 22 also, arguing that in 23 we could get very high FI flows, right? Which is FY 24. And we have seen very large FI flows in FY 24, but these phenomena still remain cyclical, right? And we need to see a consistent inflow to give you an idea that these flows have become sticky, right? But one very clear vector, which I think we are more inclined to watch, is the FPI debt flows. I think a lot of people are focusing on what will happen when FPI money flows into equity markets, but we are more focused on looking at what will happen to debt markets when FPI or foreign investors put money there. And why is that the case? Because India has gotten added to global bond indices. And because of that addition, there is a very large play which is possible, and which is what the next slide is, will talk about. So I will talk about the bond inclusion, which is the right hand side. But first, let's look at what's happening with the demand and supply of paper, right? So uh, FPI, when they put money in the bond market, they will come and buy GSEC, government securities, right? And what we are saying in this slide is that this is the right time to build bond duration portfolio. We've been saying it for the last 4 to 6 months, and we have highlighted through it various strategies also, various notes also. We believe that it continues, that play continues. And why is that the case? First is what will happen to the supply and demand of GSEC or government security bonds, right? As you can see, post COVID, the market borrowing went up significantly. Government borrowed a lot of money. Our fiscal deficit went very, very high. As you can see, FY22 deficit was very high. 23 deficit was very high. 24 deficit again was very high. But if you look closely, net market borrowing and fiscal deficit both are falling in FY25 as per the recent budget which came out, which means that the supply of government bonds, which means that the government is going to borrow lesser money. So the supply of bonds is going to be lower. Okay. Demand for bond is going to go up. And for this, I refer to the last slide, which I mentioned, FPI debt flows. As you can see, FPIs are going to buy Indian debt just because it is going to be a passive index. They have to make those purchases. They will have little room to do it. So at one point, government is borrowing less. Second, FPIs are buying more paper. So this gives us a much more clearer idea that on the longer end of the curve, 10 years, 7 years ahead, interest rates will find it very hard to go up. And therefore, any upticks that we see, we come and ask all investors to participate in India bond duration play. And if you look at, let's say, the YTMs of some of the strategies between 7 to 10 years is at 750, 760. And if this duration is at 7 to 8 years, and if this kind of supply demand scenario plays out, it could clearly outstrip whatever returns equities can offer over the next 1 year. So it becomes a very, very logical play to participate here. Additionally, our inflation is lower and global yields are also more stable now. They were rising significantly last year, but they've been stable recently, which again gives a lot of room for India duration to do well. So this is one strategy where we feel things can play out. So the first section of the report is over, where we spoke about very low vol, uh, giving you an indication that markets are too complacent, and this complacency could give way to more volatility, more correction, and deeper drawdowns. And second thing we spoke about is valuations, where valuation picture is not very conducive. Valuations are high compared to their own history, compared to the peer set, compared to the kind of liquidity that we have, and therefore it makes sense to cut down on expectations. Third, we discussed two ideas. One, BFSI, where we think valuations are much more attractive than the broader market, and the bond duration play, where buying GSEC could be a good idea. And now the second part of the section of the report is on US inflation and rates, and this we will run slightly quickly. The conclusions are very forthright. First, we are seeing that inflation drivers in US are falling. The US Fed has been waiting for inflation to fall, and those drivers are now set in place. Most inflation measures are going down, and the demand side, supply side inflation are falling. Credit growth is now negative in US. Again, something that the Fed has been waiting for, which means that reduction in credit will slow down inflation, slow down demand. Job opening, which has been very, very strong, has started to inch lower. You will remember this graph. We had put it 4 to 5 months ago also when it was at the peak. These numbers have started to slide down, which will give, wage pressures will also reduce as and when job openings, come down. And red line is the wage tracker here. So wages are also slowing down. Two or three data points were released in the last 2 3 days also. And housing, which is a very large component of inflation, those of you who've been following our Netra webinar, we spoke about this 2 years ago, saying that how this could be the game changer, and we are now seeing those numbers come down. And over the next 6 months, most likely inflation numbers in US will fall drastically, just because housing inflation is going to go lower and much lower from where it is right now. So this removes a very big hurdle for the Fed, which is inflation. So most likely, in the mid of the year or second part of the year, Fed might, look to cut interest rates. And we've covered when does the Fed cut rates significantly. It just, waits for economic conditions to deteriorate significantly before embarking on very large rate cuts. But one message is clear that economic growth more or less is slowing down. And as you can see that yield curve inversion has now lasted the highest or maximum time that it has ever done. Right? We haven't seen yield curve inversion last such a long time. And which means that inflation, which has now come down to 2.9%, this is the Fed's own measure, which is core PCE. Fed wants it at 2%. We believe that by the time we enter, March to June quarter, this number will get closer to 2% or lower, giving Fed the ability to cut rates, right? And second thing is that US economic expansion is already, very strong. And as you can see that these are the number of months for which US economy has expanded. So GDP expanding for number of months. This is data going back from 1854, right? This is what NBER, which is a US agency which dates recession, they provides this data. And as you can see, after the global financial crisis, expansion in US economy began and lasted for 129 months before COVID happened. And for 2 months, the US economy contracted. The contraction was very large, but it lasted only 2 months. Okay. In hindsight, it does appear very out of whack. In March, April, May 2020, nobody could have imagined that economic depression or contraction. Contraction is the right word, not depression. Will last only for 2 months, right? But it did. And since then, US economy has again started to expand, and it's been expanding for 45 months now. On an average, expansion phase is 43 months. If you remove the 2 months of COVID contraction, US economy has been expanding for 14 and a half years. This is the longest expansion, even if you ignore what I'm saying. And even if you just go back to the pre-COVID expansion, it was the longest expansion on record. And current expansion has already exceeded the average of last 200 years, which tells you that US economy is already in an outlier expansion zone. That means GDP is expanding for a large number of months, more than it has in the past. Now, why this data is important? This is the same data from 1948, depicted in a graphical format, where the black line shows you the federal fund interest rates, just like our repo rate, and the red line is the unemployment rate, okay, which is backed by the recession data. The gray bars are recession, right? So white periods are economic expansion. What does this chart tell you? Interest rates are now as high as they were, back in 2000 when the, dot-com bubble happened. And interest rates have not been high for a very long period of time. And this has given the economy a very long period to expand, but that easy monetary policy is no longer available, right? So there is a very clear case that the interest rates prevailing in US today can cause a large economic contraction or a slowdown. I have no idea whether it can lead to a recession or not, but it can lead to a severe economic slowdown. Whether it becomes a recession or not, that is anybody's guess, right? But this level of interest rate can cause economic contraction, and the first sign is already there, which is contraction in credit, right? And a lot of people then also question that the interest rates are already at 5.5%. Why does the US economy continue to remain very strong, right? Why is it not in recession? The only thing is that monetary policy, interest rate hikes take time to impact economic output, right? These are not stock market prices. They take months, quarters, sometimes years also to fructify. Just like by cutting interest rates in 2009, the US Fed could not revive the economy. It took 3 to 5 years for it to come back. Similarly, just by raising interest rates for 10 months, it will be very hard for them to slow down a economy which was working on zero interest rates and a big rebound post COVID. So it takes time. So there is a possibility that within this calendar year, some signs of fragility will start to appear because interest rates are very high. And also capital globally, investment capital will find it very hard to remain away from US Treasury. So think about take the case of, let's say, Indian, let's say Nifty, trading at 23 time price to earnings, an earnings yield of less than 5%, about 4.5% or so. Compare it to a US Treasury giving you a yield of 4.5-5% in dollar terms, right? Which is this is the comparison. So global capital will find it very hard to look for alternates and not invest in US Treasury, to get these kind of returns. And therefore, I think both these situations are possible where US economy slows down, and second, investment capital globally, which has got nothing to do with our domestic growth or output, but it finds the US safe haven a lot more interesting to invest in, and therefore squeezes out global flows, not only from India but also from many other parts of the world, right? And therefore, I think one very crucial question: has the Fed tightened enough to slow down growth? And we believe yes, and we've looked at the past data, and as you can see that whenever the Fed tightens interest rates to a level which is higher than the nominal GDP growth rate, this is a very old school textbook style of looking at interest rates. Most central banks have abandoned this theory. They continue to keep interest rates very, very low in order to stimulate the economy. They've been erring on the side of keeping interest rates low. This used to be a method used a very long time ago to slow down the economy and introduce disinflation and deflation in the economy back in the 1900s and 1940s, etc. As you can see, during long phases, we've seen that central banks have exercised these policy. So we believe that Fed has already tightened enough for economic growth to slow down, and which means that Fed funds rate, if you remove it from the GDP growth rate of US, is already starting getting close to 0%. That means interest rates are higher than nominal GDP growth rate in US, and that will restrict, new incremental growth in output, and which means that it makes a lot more sense to buy treasury bonds. Why? Because if growth slows down, inflation is already low, and if it slows further, yields will decline. A Fed will come and cut interest rates, and that will give a very large impetus to bond prices to move upwards. The reason is interest rates and bond prices move in the opposite direction. When you cut interest rates, yields fall, bond prices move up, right? And that is why it makes sense not only to look at duration India, but also to look at duration globally. It could be a very attractive proposition to go by. So, with this, I think I will end here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.